How are you, students? Today we are going to study how to prepare operating activity in case of main cash flow statement. So, last class, dear students, we have already known about the statement of cash flow statement. You have already understood about the meaning of cash flow statement. Yes, students. Now we are going to know about the calculation of operating activity. See, there are three statements in a cash flow statement. First one, operating activity. Second one, investing activity, and third one, financing activity. See, operating activity is the activity which is related to the many more adjustments related to non-cash expense, profit, then decrease in current asset, increase in current liability, increase in current asset, and decrease in current liabilities. See, after adjusting all these items, we will get a net operating cash flow in or flow activities. See here, first of all, we have to take into consideration net profit before taxation. Then add adjustments for non-operating items, non-cash items. That what are the non-cash items for the operating activity? Non-cash items are, it may be loss on sale of fixed asset, it may be discount, it may be any kind of past loss like a depreciation, like that. It may come. See, sometimes income tax also to be adjusted in operating activity. After adding non-cash items along with net profit before tax, we will get a operating profit before working capital changes. So after getting before working capital changes, we have to add up decrease in current asset. We know that current assets are the assets which will have duration within a year or for 6 months, maximum 1 year. So cash which tries to increase or decrease, assets which tries to increase or decrease according to the recent trend in market. For example, cash, it may increase or decrease. In business, if cash is 10,000, tomorrow it will be 20,000. Day after tomorrow it will be 1 lakh. Like that, cash, bank, sundry debtors, bills receivable, stock. These are the important current assets in the business. So current assets are the assets, its value will be changing within 1 year. So like that, assets are called current assets. So cash, bank, debtors, stock or inventories. So whatever may be the decrease, the value of current asset which goes decrease or value is coming down according to market condition. Such a difference we have to take here under the head add decrease in current assets. Then whatever may be the value of current liability which it tries to increase, liability which is to be paid within a short period of time, maximum for maximum within 1 year or within 6 months. Like that, liability is called current liability. For example, creditors, bills payable, loan, short-term loan, bank overdraft. These are the items will be treated as current liability. Liability to be discharged within 1 year or within 6 months. Like that, liabilities are called current liabilities at present. Next, increase in current asset. If the value of current assets that we understood earlier, cash, bank, debtors, bills receivable, like that assets stock, like that assets value is going to increase, what should we do? We have to detect such a value. When current asset value decreases, it should be added. When current asset value increases, that also should be added. When current asset value increases, that also should be deducted. Increase in current liability, that also should be deducted. These are the items to be adjusted in case of cash flow from operating activities. See students, once again we will understand about how to prepare cash flow from cash flow in cash flow statement, cash flow from operating activity. First of all, we have to take into consideration net profit before tax. Then add non-cash or non-operating items related to operating activity. So we will get operating profit before working capital changes. Next, add decrease in current asset. Decreased value of current asset. How to take a decreased value of current assets? For example, first year we have 10,000 stock value. Second year we have 8,000. So value of stock is coming down. So 10,000 becomes 8,000. So 2,000 is decreased. So we have to take a current asset value, decreased value of current asset 2,000. That one we have to add up. Don't worry. Next, when there is an increase in current liability, for example, trade payable or bills payable, first year it is 25,000, second year it is 50,000. Here definitely the value of current liability is coming up or going up. So it is called increase in current liability. The value of liability is going up. That difference is called current increase in current liability. Whatever may be the items related to current liability, increased value must be added. How to take the increased value? First year small amount, second year big amount. It means difference we take, it means increased value we have to add up according to the rule of operating activity, according to the rule of cash flow statement, we should be added this amount. Next, increase in the value of current asset. When the value of current asset is increased, for example, debt is first year 75,000, second year 1 lakh. Here 75,000 is the value for debtors in the first year. 1 lakh is the value of debtors in the second year. If the case is like this, you take a difference. 1 lakh minus 75,000, you will get 25,000. You have to deduct. Similarly, in case of decrease in the value of current liability, when the value of current liability is going down or when it is getting less, that amount we have to find out. then deduct. Now we got net operating what? Net operating activity. This is the first activity in case of preparing cash flow statement. No commerce students can worry about the preparation of cash flow statement. This is very important thing in your commerce life because this is very simple to prepare. Don't worry. First of all, you have to understand the meaning of cash flow statement. It is a statement which shows inflows and outflows of business, isn't it? So after preparing three heads, next step we have to make a total of three heads: operating, investing, and financing activities. These three total, we have to take these three total, that is grand total. Afterwards, add opening cash balance. So while preparing, while taking decrease in the value of asset, increase in the value of assets, we cannot take a decrease in the value of cash, bank, increase in the value of cash and bank. So here last time we have to adjust. For adjusting last time, we have to avoid taking cash and bank balance along with the operating activity. As it includes cash and bank balances are including in current assets, but we cannot include in current asset category because last we have to adjust along with the grand total. Remember. Next, dear students, next we are going to study about the preparation of investing activity. What do you mean by investing activity, dear students? Investing activity is the activity which is related to the investing category or purchase and sale of fixed assets for the business. See, investing activity is nothing but it is the adjustment of purchase of fixed assets or non-current assets. What are the fixed assets or non-current assets, dear students? Land and building. Without land and building, we cannot make a business. We cannot run a business or we cannot maintain a business. Land and building, fixed asset. Plant and machinery, fixed asset. Furniture and pictures, fixed assets. Patent, goodwill. These are the goodwill is an intangible asset. Okay, students. So fixed assets means the amount of asset which will be fixed in nature. Once the business will spend a lot of money for the fixed assets, then they can utilize it for many years. Then that assets is called fixed assets. So furniture and fixtures, plant and machinery, land and building, these are the important fixed assets. So you have to remember, in investing activity, we mainly deal with the new purchase of any fixed assets. It may be purchase of furniture, it may be purchase of land, building, or whatever may be related to fixed assets. So that is when we purchase a new assets for the business, that will be an outflow. That one we have to detect. When we sell our old assets, sometimes business may be thinking of selling their old assets. So what should we do? We have to sell it then whatever the amount we receive, that will be inflow. So purchase of any fixed assets, when we purchase a fixed asset, we have to give money to outsiders or to the company. Our cash balance will be going down. Anyhow, when there is a new purchase of fixed assets, there will be a payment of cash. So that payment is called outflow. Without giving money, we cannot procure anything. So when we purchase any fixed asset for the business, we have to pay money. So like that payment is called outflow. In cash flow statement, we have to write purchase of fixed asset. If it is purchasing for 10,000, we have to write the amount in bracket. The main aim of writing amount in bracket means it is a case of subtraction, outflow. Next, suppose we have an old-fashioned machinery or furniture. So that one, business is deciding to sell it to an outside party. So it is called inflow of business. Inflow means cash which comes into business. Inflow means cash which comes into business. Whatever may be the cash received by sale of any fixed asset, that will be treated as inflow of business. So here, inflow must be added, outflow must be deducted. We have to get the total of investing activity. Next step, financing activity. Financing activity is nothing but it related to finance or loan taking by business and its repayment. Taking loan, issuing shares, repayment of share, repayment of debenture, then taking loan and repayment of loan. These are the things related to finance activity. Finance activity. So, when we take loan, it is a case of inflow because that time we will get money. When we repay loan, we will have to pay money to outsider. That is a case of outflow. Similarly, in case of issue of share. In case of issue of share means sale of share of a company. So, if our company is going to sell its shares, company will get money. That is inflow. When the company is going to repay its share money to public or debenture money to public, it is called outflow because money is going out. These are the things we have to study in these three categories: operating activity, investing activity, and financing activity. After doing financing activity, we have to add up operating activity total, investing activity total, financing activity total. We will get a grand total. So what should we do next? Simple. We have to add up opening cash and opening bank balance along with the grand total. So we will get a closing cash and closing bank balance as it is given in the balance sheet. Okay, students. This is about the preparation of cash flow statement. So I think all commerce students would have understood about the cash flow statement. You like my channel. Today's my like target is 100. You have to subscribe my channel. Then it will be easy to get it automatically. So now the class is coming to end. Next day I will come with a new topic with one solution. Okay, students. Now this class is coming to end. Okay, students. Have a nice day.